Now, African central banks are expected to maintain tighter monetary policies to combat stubborn inflation. And while Nigeria and South Africa may raise borrowing costs, Kenya and Mozambique are likely to keep rates unchanged. The decisions will be influenced by higher oil prices, weather effects, and the US dollar's recent weakness impacting inflation. South Africa is nearing the end of aggressive tightening, with the majority predicting a rate increase. Now, Ghana's monetary policy is said to be uncertain, with different views on whether tightening measures will resume. Nigeria is poised for an extended phase of tightening due to persistent inflation triggered by several factors, and Mozambique is expected to maintain its borrowing costs amid concerns of inflation gradually increasing once a significant gas project resumes. So this morning, joining the conversation from London, United Kingdom, I have Gospel Obele, Chief Economist, Streetnomics. Thank you so much for joining us, Gospel.
Thank you for having me. Good morning, Lekan.
All right, so let's start this way. How do African central banks decide on their interest rates, and what factors are they considering when it comes to monetary policy decisions?
Yes, I mean, on one level, is the fact that the interest rates are major, monetary instruments that are used to, control price stability, control money in supply, ensure price stability, control money in supply, and also to bring about some balancing, in the economy as the case may be and when need be. So safe to say that when you have a situation where the economy is contracting, interest rates can be used to encourage more supply, of money into the space, as the case may be. And that would mean that interest rate may have to be reduced, all right, to inspire more borrowing. People would take loans because interest rates are now low. And by virtue of doing that, you have a case where, a lot more money is in supply. Then you also have a case where you have a situation where there's a lot of money in supply or high inflation. Interest rates can also be used to contract the economy. So higher interest rates are used to contract, lower interest rates are used to expand. So to a very large extent, it borders heavily on the current economic situation of things. Inflation you want to talk about, then there could be lots of bias around the monetary and the fiscal lines of governance, and interest rate may have to, come to save the day. On the fiscal side, you have taxes sort of doing the job of the interest rates on the monetary bit. But in this case now, they come in handy as a tool to keep the economy and prices in check, credits, arguments, and even supply demand side balancing, as the case may be. So these are the critical things that sort of inform when to use interest rates and how to use interest rates. The extent to which interest rates is also being used constantly over time in an economy depends to a very large extent on the externalities and the level of risk associated with probably high inflation, need to contract the economy, need to expand the economy. So the level of risk or the level of work that needs to be done determines the level at which the interest rates will be used as a tool. So in this case now, we've seen interest rates rising for almost a year now, and in a bid to sort of contract, reduce inflationary pressure on the economy. And that's where we are right now. I think going forward, I've explained the dynamics around why interest rates so far has not really done justice to inflation.
All right. So in the light of recent inflation trends in Nigeria and South Africa, so what are the potential actions that central banks may take as regarding borrowing costs?
I mean, first and foremost is the fact that when the whole inflation thingy, skyrocketed, the first approach by central bank governors, and it's not really a thing of African central banks only, globally, was to raise interest rates. And conventional economics requires you to do that. And when you raise interest rates, you actually raise borrowing costs. All right, the cost of borrowing rises. When the cost of borrowing rises, it's to a very large extent an advantage for the financial markets, the capital markets, because for every additional rate increase, they earn interest income, as the case may be, and all of that. But to the individual who is lending, it becomes an interest expense. All right, it becomes a case where access to capital, is high, becomes more expensive, and it's a lot more difficult for people to invest and do business going forward because you cannot finance cost of production or cost of business in that case may be. So it's a lot of balls to be juggling in the air. The big ticket argument will be, especially in this case, is, are interest rates enough to curtail inflation? If they are not, how do we begin to retool the use of monetary policy, to manage inflation in such a way that we can sort of gain relief in the real sector? Because right now, the high borrowing cost that we are faced with is largely becoming a risk when it comes to the cost of living crisis, cost of doing business. Individuals cannot lend money from even people, from even conventional institutions. Businesses cannot even access capital or access finance. All right, and it's a big deal, all right, and it's not sustainable to a very large extent. So, a consistent rise in interest rate over a period of time can end up is self-destructive for an economy, except something else is done to patch up or sort of a social intervention to make up for those excesses.
All right, you actually just nailed it on the head when you asked that pertinent question, if raising interest rates would actually curb inflation, as it were. So when we look at countries like Kenya and Mozambique, there's the expectation that they might just maintain their current interest rates despite inflation levels there. So what other factors do you think might influence their future decisions as regards this?
Well, I think there are also externalities that are involved, external parties that are involved. Globally, interest rates are on the hike. And, to a very large extent, the way the world works now, you need to be on the very good side of the argument, sort of like being diplomatic, being geopolitically correct and all of these things. So these are one major, externalities that are sort of shaping the use and the future of interest rates. Number two will be, the fact that we're in a highly volatile environment, all right? So the scare of what is to come can also inform unnecessary and consistent rate hike, all right? So if you look at the NPR report, you always see an analysis of the current economy. Then you also see what the judgment is by the MPC committee. And sometimes those judgments can also be very, very, you're forecasting into the future. There are lots of uncertainty around the judgment, yet interest rate may be slightly increased to curtail many of those uncertainties, as the case may be. So uncertainties, external pressure, geopolitical tensions, and impact of all those dynamics. Your lenders, your creditors, once your creditors are increasing interest rates, you're likely to increase locally as well. Otherwise, you will technically not be in the good books. And then many unforeseen narratives, especially in the case of the Nigerian economy.
All right, so let's look at Ghana now. What are the main concerns for Ghana's Monetary Policy Committee regarding inflation? Because, of course, they'll be holding a meeting soon, and they're expected to make some critical decisions as regards inflation.
Yes, so first off is to recognize the problem as a global problem, but more importantly, tackle the problem as with a local solution. So one of the major things I would expect Ghana, for instance, in this case, to do, because interest rates have constantly been on the rise over time, and inflation currently stands at over 40%. All right, the big ticket issue will be, how do you partner with the fiscal institutions, or how do you retool the use of monetary policies, to tackle inflation more sustainably than interest rates? Although the first conventional move is to further raise rates, which is likely going to be the case. You're either going to further raise it or further put it on hold. Either way, the economy is already on the high cost side. Now, besides that, will also be the need, if our governments are really thinking of sustainability, we think how we begin to tool up monetary policies to tackle inflation. All right, so it's not a sustainable use in terms of interest rates right now, but I'm really hoping somebody can really question the status quo, to look at it from a different lens. What I see a lot of time is the consistent move and the consistent use of interest rates as the best case scenario, because again, that's what conventional economics teaches. But we're no longer in conventional times. Times have changed, things have changed, and events are unfolding. So it requires a new rethinking of how we're using monetary instruments. And that's what I expect the Ghanaian Monetary Policy Committee to look at, if there's a forward-thinking approach to solving the problem.
All right, you've actually hammered on monetary policies, as it were, but then when we have issues with higher oil prices, weather effects, and the weakness of the US dollar that actually have a debilitation on inflation, and of course the African economies, as it were, how do you expect these African countries to combat that with their policies?
So first of all, by virtue of where we are on the rung of the developmental ladder, we may not be able to hide too far from these external shocks. For some countries, high oil prices is a plus because of revenue prospects and all that. But to a very large extent, many African countries do not produce these commodities by their own. Many African countries are not yet competitive globally, and the currency of exchange in the global market is the dollar. All right, so there's a perception that the risk far outweighs the benefit, or the cost far outweighs the benefit. And in all fairness, that's likely going to be the case. So the big ticket question will now be, how can African governments in the interim begin to create a safe landing around how this policy impact directly on stakeholders in the local economy, especially through inflation? And that's going to be a very big ticket question that doesn't have one answer to. So you can look at it from a social interventions point of view. You can look at it from drastically trying to also grow your access to market solution so that you can also grow your, shore up your revenue from the non-oil, sector and all that. You can also look at it from how you can begin to build that complementary effort between the fiscal and monetary institutions to work out inflation and also to work out how we respond to these global shocks. So whether we like it or not, they are coming. More is still coming. Climate change is a different conversation, and we're going to expect hikes in how global shocks are hitting the African economies as we go on in the mid to long term. So the big ticket question is that what are low-hanging fruits and how do we tap into them?
So yes, so let's go to that point now. Where are the low-hanging fruits for Africa?
Yeah, I mean, the low-hanging fruits, like I first and foremost, is to become more competitive in the global scheme of things.
Okay.
As much as it sounds like a long-term goal, it's also a low-hanging fruit. Take, for instance, for Nigeria now. There are already so many SMEs that are export-ready. And part of what is also informing inflation is the fact that you have a lot of items that are being transferred into the economy, what we term as imported inflation. All right, so to kill local demand for those things will mean that you also need to shore up supply and exports of items that are export ready and can compete in the global environment. Once you begin to create that production-consumption balancing, then prices will come at a very, very relative equilibrium. Let's not forget that part of also what is informing inflation, for instance, in the Nigerian case, is the cost of the naira in exchange to the dollar. It's also the first subsidy argument. It's also a lot of these things are hinged directly on the fact that we are import-driven economies. And in many African countries, you almost have the same narrative. So how do you counterbalance that by growing your export base, your competitiveness base, and also allowing your fiscal and monetary policies to tackle inflation? These are low-hanging fruit. Now, the reason why I may not be able to go into so much specifics is that for different African nations, the context is different, the reality is different, the structuring of the economy is different. But I've used Nigeria as a case study, showing what can be done at a very, very, very low-hanging fruit phase, and they'll take it up from there. There are already lots of SMEs in Nigeria who already export, but not through the official export window. So because of that, you can't technically capture who is exporting what, when, and how, or how frequent. But if you can organize that market enough, even the services sector, all right, it contributes about 52% right now to the Nigerian economy, but there is no data and there is no policy, national policy on the service sector right now in Nigeria. So once we can begin to take these low-hanging fruit, and right now the service sector, for that sector to have contributed 52% to GDP, imagine what the monetary value will be in real time. So there are possibilities. It's just for us to identify what the low-hanging fruits are and take it up from there.
All right, let's now look at the most industrialized African economy, that's South Africa. We see that inflation rate in the country is currently above its target range. And despite the fact that the rand is getting stronger and inflation is easing, there are still fears by economists saying that the Apex Bank might just increase interest rates in the country. So how do you think the policy makers would address this, and what are the risks that could pose a concern for them?
So right now, the rise of interest rates is looking more like a need to be politically correct, geopolitically correct, or economically correct, than doing what works for you in your context. All right. So the conventional expectation would be that, the SC economy could do more for themselves and then retain rates or maybe drop rates over time as we go on. But there are lots of more deeper externality questions involved that are shaping the constant rise in exchange rates. So you have lots of pressure mounts from the ECB, from the Fed, from the Bank of England and all that. And let's not forget, there is almost nothing that the African economy does that it doesn't route to a third-party currency. right, so when you think of the economics, the international diplomacy, and all of the angles to this thing, then you can understand why the behavior around interest rates is almost different from the need to tackle inflation and focus on the success you're gaining tackling it in the best way you can. All right. So, however, if the SA Monetary Policy Committee can deem it fit to take up the courage, to begin to further deep dive into its own context, and as a result, probably moderate rates, or maybe have a stronger reason to slightly increase rates or even drop rates, then that can be well appreciated. But what I see here is a play of more externalities, pressure involved than local context.
All right, I'd like to also find out from you. Now, how does the historically tight spread between South Africa's repo rate and the US Fed funds rate affect their monetary policy decisions, especially given that the country's current account deficit is at that peg?
Yeah, so first and foremost is the fact that the way our economies have been structured, the SA economy and many other African economies, is structured in such a way that you have so much dependence on third-party currencies. All right. Yeah, there's still the African Payment Platform and all that to facilitate the ASFT. There's still that commission on the table. That is still being developed. But ideally, right now, you almost cannot do anything, transact at a level, even within the SA economy, without making recourse or reference to to an international currency. So what I see is a lot of risk emerging, and there's also a commission that the next level of quote unquote instability or crisis is what we term as currency wars, and that's because there is too much of pegging and dependence on stronger, quote unquote, stronger currencies and all that. And we see that in our balance sheet, in our balance of payments, balance of trade, and the like. So I think it also requires that the African economy or African economies stand up to be more self-reliant in their economic policies and how we're also structuring what works for us. And also the need for instance, an SA to partner with a lot more other African countries to make things work the way they can within the African land. So an SA alone cannot win the argument for or against pairing, with other global currencies. It's almost a lost case. All right, Africa and Africans themselves have to partner more together to find what works within the context of our reality, and then build stronger economic policies that can contend globally. Anything outside from that, regardless of what the balance of payment looks like, is a form of further externality pressure, because either ways our currencies are pegged at the level of transactional engagement with other global currencies.
Okay. Now, Gospel, let's bring it back home again and talk about Nigeria. With inflation at 18-year high in the country, what are the challenges and price triggers that you think may likely keep inflation levels elevated? And how might the new administration stance on interest rates impact the central bank's decisions? Because we've seen the new Nigerian government come up with different policies that might be quite inimical and not helpful for the Nigerian economy and, of course, for the business community. So what do you feel about the stance or the projections or what the Nigerian government might do as regards this?
To be very honest, the Nigerian government have limited options. And it's safe to look at it from two angles, because number one, there are a lot of complex decisions to be made right now, the way it is in Nigeria. And many of those decisions cannot be taken without some level of trade-off. And what we've seen over time is that there's been a lack of preparation for the trade-off or the downside impact of those policies. But actually those policies need to be taken. All right, so it's not a commission of if those policies will be taken, it will be a commission of when. But big ticket issues will be how do we deal with the trade-off? All right, and these are actually big arguments, because then again, since the past central bank governor was suspended, there hasn't really been any statement to say this is the direction of the monetary institution going forward. However, the language of the fiscal authority hasn't looked as though it has endorsed many of its policies in recent times. So we're looking at on one end a decisive fiscal authority and a very uncertain monetary institution. And looking at how that developing story will shape interest rates is something I'm also excited to see. All right, are we going to play towards the conventional argument of the local and the West, or are we going to have some form of influence from the fiscal authority to say retain rates or drop rates? Because then again, you want to take into consideration the roller coaster of policies in recent times that have impacted on inflation and cost of living. All right, so full subsidy, and the recent unification of the exchange and all that have impacted the people way more than just inflation itself. So we've seen cost of living veering off to build its own narrative than just what the inflation numbers are saying, all right, going forward. So the government technically have two things to do: deal with inflation, then deal with cost of living. Because the cost of living now we are faced with is not just a function of just inflation only. It's also a roller coaster of many policies that have impacted the consumer at the very basic of the necessity, that they have to get by with on a day-to-day. So there are many complex issues that the current administration need to deal with. But we are yet to see what the policy direction will look like. Ministers are yet to come on board. We're yet to see who is really responsible for the affairs of the central bank governance, as the case may be, and then what that would mean for the overall outlook of the monetary institution in Nigeria, or financial services in Nigeria.
All right, just to wrap it up quickly, I'd like to take your stance on this. What about countries like Mozambique, Lesotho, Eswatini, who have fledgling economies? Do you think they will need also to be drastic when it comes to making monetary policies for their economy to deal with inflation and other economic shocks?
Honestly, I think they need to be, because the times are changing. And everybody's going to feel the impact, and maybe severe. Some will feel it more severe than others. The goal is to prepare, and that's the only thing. They can only control the outcome when they prepare. All right. So I think that wisdom requires that every nation right now in the world begins to prepare for what is to come. And it's very, very critical, because you cannot necessarily tell within the context of VUCA how lots of these arguments into geopolitical tensions, climate change, post-COVID, cost of living crisis, rising interest rates will impact on economies and the competitiveness of these economies going forward. So it just makes sense to prepare and the stage and prepare for the worst, and all that. And that's technically what change leadership will mean. Identifying these elements, taking note of trends, and then asking yourself, what can we do to be on the bright side of that divide? And that's change leadership, proactively envisaging the problem and preparing for it. Anything short than that will be status quo, and with very much likelihood retrogression. Because as things begin to change, if you don't change accordingly, you are staying on one spot will technically mean you're going backwards.
All right, thank you so much, Gospel Obele, Chief Economist, Streetnomics. Thank you so much for your time.
Thank you for having me.